Today we're going to go over how to get pre-approved for a home loan in 90 days or less. So a pre-approval is your first step on your path towards home ownership. It's a lender's conditional agreement to offer you a mortgage based on an evaluation of your financial standing. In this section, we're going to detail why a pre-approval is important, we'll demystify the process, and we're going to provide you with a clear roadmap on how to achieve it. So why 90 days? 90 days is an optimal time period that's going to allow you to strengthen your financial position. It's also a realistic time frame to correct any credit inaccuracies, save that remaining amount that you need towards your down payment, and it allows you enough time to get all of your financial documents in order. So let's look at this from the lender's perspective. The lenders are going to want to see a few things. They want to know your credit history, your debt to income ratio, your employment history, and with that, income stability, and they want to see your assets. So the first step in your pre-approval process is going to be your application submission. This initial step is going to require you, the borrower, to fill out an initial application that gives us a picture of your financial history and information. It's during this point that we're going to perform a credit check. They do this for a few reasons. A, we need to know what your credit score is. And then B, we also need to know how much your monthly payments are. And then C, and a big reason why this process could take 90 days is if we find any credit inaccuracies, we need at least 30 and up to 90 days in order for us to help you fix that situation. We're also going to need to perform some document verification. We're going to ask you to provide us various documents such as income statements, tax returns, and your pay stubs in order to verify the information that was submitted on your application. So once we've completed that part, we'll go ahead and assess what we think that you're pre-approved for, which is essentially how much we think you can borrow. So once you're approved, we'll send you a copy of that pre-approval letter, which more often than not is going to be required when you're submitting your purchase agreement. So as you can see from this pre-approval process roadmap, step 1 is your application submission, step 2 is your credit check, step 3, we're going to verify all of your documents, and then step 4, we'll perform that assessment. As long as everything matches up at that point, we'll go ahead and issue that pre-approval letter. So what exactly are we going to need in order to issue you that pre-approval? Here's a quick checklist as far as the most common documents that we need in order to get you that pre-approval. Now, if we need anything else, we'll be sure to let you know right away. But as you can see here, we're going to need the following: 2 pieces of identification, your last 2 pay stubs, 2 months worth of bank statements, your last 2 years W-2 or 1099, and then your last 2 years of tax returns. So in preparation for your mortgage application, organizing your assets is a crucial step that's going to let the lender know that you have the financial resources necessary for a down payment, closing costs, and other related expenses. And a real quick tip, we have a video that's going to explain the differences between down payment and closing costs, and we'll go ahead and provide the link below. But for now, here's how to get your assets in order. So the first step is going to be the documentation of your assets. What you're going to need to do is collect all of your recent statements. Now we're going to need 2 months of your checking, your savings, and any investment accounts that you're going to use for the transaction. We're also going to need documentation for any retirement accounts that you have, something like a 401k, an IRA, or a 457. Now, if you have any large deposits that are showing on any of these statements, what we're going to need to do is we're going to need to document this, and we'll go ahead and walk you through how to do this. So essentially, it's called a letter of explanation, and we'll show you how to do this in the process. So the second step, we're going to source your down payment. Essentially what this means is that we're going to need to identify where your down payment is coming from. Now, if your down payment is going to be gifted, we're going to need something called a gift letter that shows where that gift fund is coming from. Now, the easiest way to take care of all this is to ensure that your down payment is in those accounts that you want to use at least 2 months prior to starting this process. That way you can avoid any funds that need to be sourced. Now, the third part of this is maintaining your asset stability. Essentially, all this means is avoid any large purchases or moving money in and out of accounts. And the reason is, if you do this excessively, it's going to raise a red flag with the lenders and require a lot of additional documentation. Just remember that the lenders are going to be reviewing all of your financial activity a few months prior to your application. Now, the fourth part of this is proof of any additional income. This is referring to any income that you're getting from dividends, interest, or rental properties. So if you're going to be using anything like dividends, interest, or rental income, make sure that you have the proper documentation available. So this is going to include any tax returns, rental agreements, and maybe some brokerage statements that show a consistent income stream. Now, step 5 is something that's called reserve funds. Now, lenders may require you to have reserve funds in your accounts in addition to your down payment and closing costs. These reserves are typically enough to cover several months of mortgage payments. So step 6 is explain or eliminate your debts. You're going to want to pay down significant debts if possible, as this will improve your debt to income ratio. And remember, be prepared to explain any outstanding debts or liabilities to your lender. So now that we've gone over what we need, let me give you some tips to help you out during this portion of the process. Start early. Begin the asset organization process well before the 90-day mark to ensure everything is in place when you're ready to apply. Step 2 is keep records. Maintain a file of all of your asset documentation. This is going to include any statements and letters in order to streamline this portion of the process. And the third tip is understand your liquidity. Some assets may be liquid, which just means it's easily converted to cash, while others are not. Lenders typically prefer funds to be liquid as they're easily accessible. So how does this impact your mortgage pre-approval? Having your assets in order demonstrates to the lender that you're financially prepared for your home ownership. It can affect, number 1, your loan amount. The more assets you have, the more you can qualify for. It also can affect your interest rate. A strong financial position can affect your interest rate. And your loan terms. Better terms may be available to those have a stronger financial position.